My last guest from Nomura said to me, actually, this was a subtle sort of hint that not only are they going to want to try to get to 2%, but possibly compensation. In other words, we need to begin to expand our minds about what compensating for the bygone era of misses really means. What would you interpret a compensation factor to be from the Fed?
Well, I think what they're unhappy with to a degree is that the economy's been running so well in itself over the last year, that the labour market's been strengthening, that growth's been strong, and yet inflation and PCE has been persistently below that 2%. So they're just trying to let the markets know that that isn't good enough. They want to get the level back there sustainably. They want to increase market inflation expectations. So essentially, they're just expressing this more tolerant view. And if that rate does get back to 2%, they're going to be less determined to sort of chase it down. So it does talk about a change in their reaction function, I think. And I think they were sort of floating that idea to see what the market did with it. And it was interesting to us that break-evens didn't really move. In other words, the market's pretty relaxed about them taking that sort of attitude. And as we were talking about before, there are some sort of downside risks out there, arguably proliferating, and not just with the Fed, but other central banks in slightly different contexts do seem to be adopting a more proactive response, a willingness to act more rapidly to any downside risks and so on. And that's what's being priced into interest rate markets at the moment.
Yeah, so if average inflation targeting becomes the modus operandi, you said earlier that you're targeting a 1.25% handle on the 10-year yield by the end of the first quarter. Would you be wanting to put any trades on in break-evens, even as you didn't see much reaction in them yesterday?
Yeah, I mean, not really, because this is the point. It's a sort of reminder that although central banks are trying to keep up with their inflation targets, they're really struggling to do that, even though, they have had, in the case of the US, certainly a reasonably robust underlying situation. So for us, this is more about a sort of move in nominal growth expectations and a sort of drift down in those nominal yields that we're looking for over the balance of this quarter and indeed the first half of the year.
John, you said your target by the end of this quarter, and I was sort of quite taken aback in the break, was 1.25% on bonds. By the way, Scott Maynard over at Guggenheim is with you. He says 1.3%. My question to you is this. Fed fund futures are pricing in one rate cut, one, by November. So we've pulled that forward. Are we underpricing the nearness of a cut? Should we be pulling that further forward on Fed fund futures?
Yes, in a word. I mean, our forecast, we acknowledge, is a very aggressive one compared to most. We think the Fed could cut 3 times by around the middle of the year, or, that there's still scope for them to do that. Clearly, that is, as I say, out of consensus. March is not remotely anticipated, but we still think there's scope for that. We're expecting to see retail sales soften more. We're certainly expecting to see jobless claims pick up quite significantly over the coming weeks. And that will essentially start to reinforce what the Fed chair was talking about yesterday about consumption, as he put it, moving from strong to moderate settings. If they see signs of a slowdown, and clearly it could be China and coronavirus related, they will stand ready to act swiftly. And this new attitude to inflation, I think, cements that.
John, the other big focus in the news conference, of course, was the repo response. Bill Dudley's got a column saying the Fed's repo response isn't fueling the stock market and that equities are being driven by low rates and a healthy economy, not central bank T-bill purchases. Agree or disagree?
Well, I mean, policy is obviously at stimulative settings, and as they, pump reserves into the system, it's going to find a home somewhere. I think if you look at the US stock market, in the context of the economic recovery they've had and so on, it seems pretty clear to us that some of that is about the way that the Fed's been using policy, but they have been doing it for technical reasons as well. We saw the Fed funds effective rate spike above the target range in September, and they're trying to make sure that doesn't happen again. That's why they're doing this. That's why they're moving things around with the IOER rate as well, and they are successfully keeping the rate within the band. So I think it is fair to say it's more a monetary policy operation.